Hi there, and welcome back to Retire Your Way with ILG Financial. My name is Chase Lopez. This is Dave Lopez, and we're both investment advisor representatives at ILG Financial.
Yep.
And today we're going to talk about down stock market, choppy markets, and how that will affect your income in retirement.
Boy, we sure, and it's a great topic to talk about because you'll go through in your investing life, prolonged periods that we call bull markets. Everyone's heard that term, bull markets, when the market's going up, up, up. Great example is roughly 2012 to 2021.
Yep.
The market went up, 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 and it seemed like there was never a down period. And boy, isn't it easy to forget when things are going like that that's not the norm, that things just don't always go up. And we hear it all the time. You know, people say, I'm willing to take risk for additional returns. But often what we find is when things get choppy and people start to panic, they never really internalize this idea that the word risk means that there's times when not only will you not get better returns in the bank, but you'll actually lose money. And then from early January of 2022
Yes.
through May, and the markets were down significantly. I think the S&P was down 15 to 18%, depending on when you looked at it. Some of the other indexes were down more, right? But very choppy and not what people were used to after a 10-year run of an up market.
Boy, I think you hit it right on the head there, Dave. When we get lulled into these kind of false sense of the market's always going up, to your point, right? When these down markets happen, it can really be a gut check to people, especially in retirement or as they approach retirement, when they've been saving all of this money for their entire working careers, really. And the whole idea was, hey, I saved this money, I took risk, to your point, and it's paid off, right? And now I'm getting close to retirement or in retirement, and now the markets get choppy. Boy, that can really scare some people, can't it?
Yeah, and let's talk about exactly why that happens as opposed to other times in your lives, because we have a huge advantage, don't we, with seeing hundreds of folks in or near retirement. And we see this over and over again, this idea that they become much more sensitive to market risk as they get near retirement or in retirement, even though they don't understand why. And I would propose for many people, here's the reason why. Most of us, as what we've talked about all the time, and all of our clients are here, this accumulation phase of your life.
Right.
Roughly that's from age 16 or 17 when you first make that first check and save a little bit of money towards retirement, right up to 5 or 6 or 7 years before retirement. You're accumulating your wealth for retirement. And the rules for folks are very similar because we're just saving for retirement. That's everyone's goal. So one of the things we hear over and over is when the market tanks and you've got, let's say, an IRA or Chase, a 401k, what does everyone tell you?
Don't touch it. Don't look at it specifically.
You bet.
Right? And don't panic, right? Don't panic and sell.
Yeah, and keep having your paycheck go in, because now you're buying stocks on sale.
Right.
That's a fantastic strategy. But one of the reasons it's easy not to panic is because everyone's been told that, so they don't look at it. But in the back of their heads, I would propose, it's not real money. I'm not even looking at it or touching it for 30 years. So does it really matter what happens today when I'm 30 years old?
Right.
Right. And I would argue your life is not changed because your paycheck keeps coming in, which is what you use to pay the bills. It hasn't affected your life at all. It's easier to pretend this isn't affecting you.
Right.
Now, fast forward, here at retirement, you have now, whether you acknowledge it or not, at a subconscious level, you know this, have saved all the money you will ever save again in your life. Right? There is I'm not going back to work for 20 more years because I invested poorly.
Right.
Some people have to, unfortunately. Right? But for the most part, you're hoping, I don't want to work again. This money has to last the rest of my life.
Right.
And I can tell you from experience, watching folks weather the volatility of a bear market or a choppy down market, when you know you've got a set amount of money and this is all you're going to earn, and your income now may vary.
Right.
If you're pulling money out of those accounts, let me give you a great example, Chase. Let's say that your thought was someone told you could take 5% out of your accounts and you probably would never run out of money.
Makes sense.
Well, if you've got $1 million, that's $50,000 you're taking out. And if you've budgeted and that along with your other checks, Social Security checks, you're like, this works.
Right.
Bang, the market crashes. Think 2008, the S&P dropped over 50%.
Right.
So let's say your account temporarily, if you don't panic, drops 50%. Now you've got $500,000.
Right.
Well, if you're going to continue to take $50,000 out so that your lifestyle doesn't change,
right,
that's no longer a 5% withdrawal, is it?
Right.
It's a 10% withdrawal.
Right.
So if you haven't planned for this, right, a lot of times an advisor will say, well, just back off and take out less, drop back to $25,000,
right,
so you're only taking 5%.
Right.
Well, that doesn't work.
Right.
If you need $50,000 to live in. So you can see the problem.
Boy, and to your point, the 2008 example you used, I'm sure folks going back to that time in 2008 read article after article about people having to go back into the workforce in retirement for that exact reason. They couldn't take a 10% withdrawal. It wasn't feasible in their plan.
Or cut back.
Right, exactly.
It's a great theory to just cut back.
Right.
You can't go to your landlord and say, hey, because of the market, I'm going to pay half my rent.
Right.
You understand, it's a financial strategy.
Right.
So what do we do?
Yeah.
Right. That's what we're about here with our these videos. We want to offer a challenge and talk about a solution. So what do you do if maybe now is the first time you're seeing a choppy market, or maybe you're a little frightened? What's the solution, Chase?
Yeah, so I think the biggest thing for folks, and really the biggest takeaway, if you were to take anything away from this video today, is make sure in your retirement plan, whether you built it yourself or you built it with a advisor possibly, make sure that that retirement plan has a contingency in place if the markets don't do what they've always done. Right?
Yeah, and I'll give you a really quick takeaway. A rule of thumb we tell everybody, whether you're in retirement or not, is know that the normal way the stock markets work are great times and retracting times. Just like your lungs, expansion, contraction. That's the normal operation of the stock markets. And if you don't plan for that, you're planning for disaster.
Yep.
Now, so what I say is any money that you have invested in the market, you want to plan that in a worst case scenario, think a 2008 crash, you're willing to leave that money untouched for a minimum of 10 years.
Yep.
And we're not the only one that says that. Several financial planners, if you push them on that, they'll say that should be your plan. If you can do that, you will, for the most part, based on historical numbers, be completely unaffected by major market corrections. Now, that's easy to do when you're 30. That's the whole plan, right? In fact, by law, you can't take the money out of your 401k without a penalty.
Right.
But in retirement, all it means is you've got to kind of tweak your system. So you've got a plan for the income you need for the next 10 years so that you can leave the other money in the market. And then every year now, you can take maybe a year's worth and put it in something more conservative so that you continue to have, as you progress and get older, there's always the money in the market is money you could leave no matter what. Then you can enjoy retirement, I would suggest.
Boy, that's a great point. Really, and I think you really drove it home there. The money that we have in the market, right, should never be being used for short-term income, right? That money that you need in the short term for income should be in vehicles that don't go negative, right? That would be, so cash as an example, right? And there are plenty of other different vehicles out there where you can grow your money, right, without taking that extra risk that we talked about.
Yeah, by design, they're not designed to have that big of a fluctuation or things that spit off income. So, for example, if you had rental property, you're still going to get that rental income if it's a good piece of property. You know, one exception to that you could be a part of the plan, a lot of people do, is if you've got stuff in the stock market that specifically you've purchased specific dividend-paying companies that you're very comfortable with, think they're strong companies with a long history that even in bad times they didn't cut back on their dividends, and you're living off the dividend income. To me, that's a little like owning a rental property, right? It doesn't matter if the price of the stock or the price of your rental goes down. If you're going to hold them forever, all you care about is that the rental income or the dividend stays the same. Now remember, with a dividend, even strong companies, there's no guarantee that the dividend stays where it is. In bad times, they can cut the dividend or stop it temporarily. So again, you want to be very careful about, if you've got your income set that you need that dividend based on that rate, you could run into some trouble if we have a prolonged recession or depression and these companies stop a dividend or pull them back drastically. But that's a better strategy in the market for money that you need than just companies that either don't have dividends or don't have reliable dividends.
Exactly, and I think it's important for folks to know that, and I think this is a little bit of a misnomer out there, that companies are not obligated to continue their dividend, right? That is a choice that the company makes to pay out a dividend to their shareholders. So at any given time, they can either, to your point, Dave, lower the dividend or completely eliminate it if they want to use that money for something else.
Yeah. So a takeaway for today would be that's an idea of how you could use the stock market, but please understand, in retirement, you're not limited to just stocks or bonds. So there's several vehicles, especially vehicles designed specifically to give you income in retirement. And there's several different ways that can be done that protect that bucket of money from stock market loss. And then you can use your money in the stock market for maybe future inflation hedge. And we've had a video on that, or how you could use that, or just money you don't need, but you want to try to keep up with inflation and maybe down the road use it for trips or fun money. So it's really, you want to be very intentional as you get in or near retirement about using your investments and basically break it into different buckets based on how you plan to use the money. A 10-year bucket for income for the next 10 years, an inflation bucket, a bucket for trips or graduation or gifts for the kids. That all needs to be done, and that for many of you is the first time that's had to be done, because prior to that you needed really one bucket, which was the save for retirement bucket.
Exactly. So if you haven't planned for that, we strongly encourage everyone to get with a financial professional to help you really build out that plan for those different buckets, and be very, to your point, Dave, very intentional with each of the investments that you have. Thank you all for joining us today. If you want to click the like and subscribe button to see our next videos. Also, if you want to click the bell as well, you'll get notified for any future videos. And we'll talk to you soon.
If you click that bell, I'll literally ring the bell every time a new video comes out. So you'll know I'm doing that for you.
Talk soon.